Unbiased Reveal channel. Welcome to the deep dive, where we try to unpack these really complex financial stories and find the actual signal in all the noise. I'm Jenny.
And I'm Peter.
Peter. Okay, we're diving headfirst into, the ultimate market paradox today. Seriously. Here's the quick version for you. Bitcoin, trading above $110,000 U.S. stocks, historic highs. And yet, the market is just choking on fear.
Right. It makes no sense on the surface.
And so why? Well, it seems institutions are, gobbling up the blue chips, the big names. But most everyday traders, their portfolios, especially the ones heavy in altcoins, they're crushed. We're talking down like 40% since January 2025.
Yeah, a completely different reality for them.
Exactly. This huge gap, this cognitive dissonance, it's creating chaos. And it's all happening right before this really critical Trump and Xi Jinping meeting at APEC this week. Big stuff.
It's a perfect storm, really. Looking at averages like BTC and the S&P just hides the real pain underneath for, well, probably 90% of people in the market.
Totally hidden. And hey, for those of you curious about the platforms where all this institutional action is happening, the big players like Binance or Coinbase, we've got the absolute best referral link for you down in the description. Seriously, check it out before the market makes up its mind. Okay, so let's unpack this fear paradox. How can the market feel so bad when Bitcoin is sitting comfortably above $110? It's weird.
It is psychologically very disorienting, isn't it? The crypto fear and greed index, it's at 39. That's firmly in fear territory.
39, wow.
And what's really striking is this isn't just like a quick dip after a crash. This feeling, this fear, it's been hanging around for over 2 weeks now, just completely ignoring Bitcoin's high price.
That's some serious pessimism holding on tight, especially when the main asset is, setting records. Where's this negativity actually coming from? Who's pushing it the hardest?
Well, from what our sources are showing, the loudest voice, the main driver, seems to be the Chinese language crypto community. You see it a lot on platforms like Twitter, WeChat, influencers there, people with huge followings, names like Chapo Lenge or Aogan Capital. They are really hammering the message. The bull market is over. Done.
But wait. If you've got massive institutional money flowing in, like actual new capital hitting the market, how can this influencer narrative, which seems based on past cycles, just override that? Doesn't seem logical.
Because for them, the Bitcoin halving cycle is basically gospel. They have these very specific cycle theories, sometimes tracked down to the exact day count, arguing that history just dictates the bull run is mathematically finished.
Wow.
And they believe the cycle stuff overpowers everything else, macroeconomics, geopolitical events, even the billions flowing into ETFs. For this really influential group, we've hit the top and the slow grind down of the bear market. It's already started.
The power of that narrative is just incredible. And this split, this divergence, it's not just a crypto thing, is it? The stock market's flashing similar weird signals.
Oh, absolutely. You look at the S&P 500 hitting historic highs, right? Especially after that little jump late last Friday. But the CNN Fear and Greed Index for stocks also showing fear, down in the 30s, just like crypto.
Okay, this is like the financial version of being technically overweight but somehow starving to death. How does the main index hit an all-time high while the sentiment gauge is just screaming panic?
Yeah, you really have to look beneath the hood of the S&P. The top line number, the index price looks great. But the indicators tracking the health of the broader market, they're flashing red.
Like what specifically?
Things like stock price breadth. That's basically the ratio of stocks hitting new highs versus new lows. It's weak. And demand for high-yield bonds, junk bonds, also signaling extreme caution. People aren't reaching for risk.
And crucially, this downturn in sentiment, this fear hitting both crypto and stocks, it seemed to start almost at the exact same time, right? October 10th. What kicked that off?
It lines up almost perfectly with the sharp escalation in geopolitical tension. That's really when the market started seriously pricing in the risk of conflict, particularly after some comments from the Trump camp about maybe slapping like 100% tariffs on China.
Oh, okay.
That kind of uncertainty just acts like financial gravity, doesn't it? Pulling down sentiment in both markets, even if Bitcoin's price tag looks high on paper.
Which brings us smack into the middle of this whole conflict, the benchmark problem. It feels like if you ask 10 people right now, bull or bear market, you'll get 10 different answers.
Yeah.
And the source material we looked at shows it really just depends on where they started, their benchmark.
Precisely, yeah. If your benchmark is Bitcoin, bought anytime recently, you're in a massive bull market, no question. If you maybe bought Ethereum early in 2025, you're probably doing okay too.
Right.
But if you're
Same.
holding almost anything else outside those blue chips, the data tells a very, very different story.
We absolutely have to talk about the Others Index. This is the one that tracks basically all the crypto market cap except the top 10 coins, or even Total 3, which takes out Bitcoin, ETH, and stablecoins. What are these smaller cap indices actually showing?
They are painting a picture of an undeniable, pretty brutal bear market. Let's take the Others Index market cap. It started January 2025 above $360 billion.
Okay, 360 billion.
Today, it's struggling to stay around $255 billion.
Oh,
That's a huge decline, a 40% drop for the vast majority of crypto assets out there.
40% decline. Okay, that 40% hole in people's portfolios. That's why the overall fear and greed is stuck down at 39, even with Bitcoin flying high. This really gives us our first golden sentence, doesn't it? The definition of crypto really depends entirely on what your portfolio is holding.
It perfectly illustrates the Matthew effect, that biblical parable where the rich get richer, the strong get stronger, and the weak, well, they fade away.
Yes, that analogy is just perfect for right now. In stocks, all the money flows into the Magnificent Seven, right? In crypto, it's pouring into Bitcoin and maybe Ethereum. The capital just picks the winners, the already successful, validated assets.
And where's the average retail investor looking? They're not usually trying to squeeze out, 50% from an already huge asset like Bitcoin. They're holding like some obscure altcoin, hashtag 165.
Hoping for that 100x, yeah.
Exactly, because the smaller market cap theoretically offers that massive upside potential. But in this Matthew effect market, that potential gets starved of liquidity. So these smaller projects just continuously underperform, which then just fuels more fear. It's a cycle.
That's the critical link, isn't it? The retail investor fuels the fear because their small cap bag is actually crashing, which then makes that bearish cycle narrative from the influencers seem totally correct. Okay, so if retail is selling out of panic,
Yeah.
who's on the other side of that trade? Who's doing the buying?
The institutions. And the data here is really, really clear. Let's just look at where the Bitcoin is held, the custody numbers. Centralized exchanges, which we kind of use as a proxy for retail traders, they still technically hold more Bitcoin than all the US spot ETFs combined. It's about 2.4 million BTC on exchanges versus roughly 1.3 million BTC in the ETFs.
So retail still holds more.
Yeah.
That sounds, okay, right. Maybe not so bad.
No, because the trend is the whole story here. Since those spot ETFs launched back in early 2024, the amount of Bitcoin sitting on exchanges has been going down continuously. Retail is either selling it or they're moving it off into their own wallets, self-custody.
Okay, so it's leaving exchanges.
Meanwhile, the amount held by the ETFs, it's going up continuously, monotonically. They're buying the fear, plain and simple.
And what's really, kind of shocking is when you add up the ETF holdings plus the holdings of strategic reserve companies, think Microsoft, they'd have like 800,000 BTC plus what some governments hold. That combined institutional pile, it already holds more Bitcoin than is left on all the centralized exchanges combined.
The implication is crystal clear. When you, the individual investor, maybe sell your Bitcoin or your Ethereum because you're scared about geopolitics or the halving cycle theory, there's a massive, well-funded, calculated institutional player on the other side, happy to take it off your hands.
And these same institutions, these giants, are pushing to make these assets even more legitimate. It's almost funny, the irony when you talk about JP Morgan, right? Given their history of kind of looking down on crypto.
Well, JPM is now actually moving to allow its clients to use Bitcoin and Ethereum as collateral for loans. This comes after the firm started accepting things like BlackRock's iBeat ETF as legitimate collateral, too.
That is, you really can't overstate how big a milestone that is. Think about it. When super wealthy people need cash, they don't usually sell their Tesla stock, right?
Huh.
That triggers huge taxes. No, they borrow against it. They use the stock as collateral.
Exactly.
So JPM treating Bitcoin and Ethereum with that same kind of financial legitimacy, that's about the strongest fundamental bull signal you could possibly ask for.
And the innovation underneath is still happening, too. We're seeing lots of bullish potential in future tech, like EIP 402. That's an Ethereum improvement proposal looking at integrating AI, blockchain, and payments. It's driving this whole concept of machine-to-machine, or M2M, transactions.
M2M, right, the washing machine ordering its own detergent. Okay, let's dig into that a bit. Why does the washing machine need a blockchain wallet? Why not just hook it up to a bank account?
Because M2M relies on these tiny autonomous micropayments that need to be instant, totally secure, and crucially non-custodial, meaning no bank or central third party needs to approve every little transaction.
Oh, okay. No middleman.
Right. Imagine that washing machine runs out of soap. It needs its own digital identity, like a self-sovereign ID, and its own wallet so it can autonomously order and pay for that refill in real time without you doing anything. This future goes way beyond just people buying things online. It requires huge adoption of assets like Ether and specialized platforms to handle potentially billions of these real-time, non-human transactions. The potential growth there is just enormous long-term.
Plus, you add in other fundamentals, like, inflation coming in lower than expected. It's down to 3.0% annually now. That makes a Fed rate cut pretty much a sure thing soon.
Almost 100% certainty, yeah.
And you've got top execs at BlackRock and Fidelity basically saying that tokenizing real-world assets, putting things like bonds, real estate onto the blockchain is inevitable. I mean, fundamental signals seem overwhelmingly bullish.
It's a beautiful conflict, isn't it? The institutional fundamentals are screaming buy, while retail psychology, driven by those altcoin losses, is screaming sell.
Okay, so now we pivot. We have to talk about the single biggest known unknown right now, the one event that everyone agrees will have 100% market impact, pretty much regardless of those fundamentals we just discussed.
Yeah, we're talking about the huge APEC meeting in South Korea, specifically the interaction everyone's waiting for on October 31st between Donald Trump and Xi Jinping.
The entire market just feels frozen waiting for this. And Trump's rhetoric has only amplified the tension, hasn't it? Saying things like, something will work and it will be a big one. Very dramatic.
The best case scenario is pretty straightforward, I think. They have a surprisingly positive meeting, maybe reach some kind of agreement, ease trade tensions. If that happens, global optimism could snap back, and the market probably flips hard into risk-on mode. That could be the trigger for the big upside move people have been anticipating.
Could be massive. But the downside risk feels equally huge, maybe even catastrophic for the short term. If that meeting fails, or worse, if Trump doubles down on those protectionist threats, like the 100% tariffs we talked about.
Which really spooked the market back around October 10th.
Exactly. If that happens, we could see a really sharp plunge, right?
Yeah.
One that completely validates all that underlying fear the retail market is feeling.
And the real difficulty here is just the sheer unpredictability of the Trump factor. He's famous for misdirection, isn't he? Often doing the exact opposite of what he signals publicly. So trying to forecast the outcome is, well, it's basically impossible. The market's paralysis right now is totally justified by that deep uncertainty.
This inherent conflict, this push and pull, it leads us right to our final golden sentence for today. When you look to the bear side, you find 100 reasons. When you look to the bull side, you also find 100 reasons.
Yeah, and the state of the market for you, the listener, really depends entirely on which set of those 100 reasons feels more real or more applicable to your own situation and your own portfolio right now.
So we've walked you through this paradox of fear living alongside record high prices. We looked at the critical split between Bitcoin and the altcoins proving that benchmark problem. We saw the institutional gold rush happening underneath.
While retail feels the squeeze, yeah.
And we've highlighted this enormous political meeting that honestly feels like it could define market sentiment for the next 6 months or more.
And the data really suggests that institutions are viewing this current fear not as a reason to run, but as a buying opportunity. They're rapidly accumulating these blue-chip digital assets like BTC and ETH and pushing hard for them to be accepted as legitimate financial collateral.
So we'll leave you with this maybe provocative thought to chew on. Are you mostly holding the strong assets, the ones benefiting from this Matthew effect? Or are you in the altcoins that seem to be fueling that fear index? And the big question, will this Trump XE meeting bring a surprise breakthrough? Or is the unpredictability going to lead to another sharp market shock?
We've laid out the facts, the conflicting narratives, the data points from our sources as we see them. But ultimately, we're just the guides here. How you apply this knowledge, well, that's entirely up to you.
If you found this deep dive helpful, definitely hit that like button and subscribe so we can keep making more of these for you. And don't forget, we've got the best referral link down in the description for those platforms we mentioned earlier. Welcome to subscribe to my channel and like this podcast so that I can continue to make more podcasts.